The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey everybody, this is the Tax Lady, and this is our hour to talk taxes. We want to make sure that you know everything that has to do with your taxes, and that's what this show's all about. And again, during the week, if you have any questions and we're not on the radio, you can go to our website at egtax.com, ask the Tax Lady, and we will be happy to help you with that too. But we're in full swing. Tax season's got 23 more days until April the 18th. So we're ready at EG Tax. Our offices are open 9 to 9 Monday through Friday, 9 to 5 on Saturday. Call to make an appointment as soon as you can. Spend the weekend. I mean, Sunday's a great day to go through your receipts. I know that's what I'm doing tomorrow because I'm going to do my tax return tomorrow. And it's a great time to get all your things together because you don't want to wait till the last minute. If you find out you owe money at the last minute, it can be really a problem because you won't know necessarily what to do. So, and today we want to talk about capital assets and inheritance and gifting and things of that nature. And of course, I'm joined in studio with Chris Fabian. Hey, Christopher.
Hello, Esther.
Hello, Christopher. Okay, so that's what we want to talk about, capital assets. Now, capital assets are the sale of anything other than what it isn't. Isn't that true? Isn't that how it's described? A capital asset is everything except for money, depreciable assets, inventory, right?
Right.
And everything else is a capital asset. So if you sell your wedding ring, that's a sale of a capital asset, right?
Yep.
But it's a personal capital asset.
Yes. Yes.
And so the sale of a personal capital asset at a loss would not be deductible.
Right. Right.
But
Yep.
if you sold your personal capital asset at a gain,
then it's taxable.
righto. So, with everything being a capital asset, you want to make sure that you understand that personal capital assets sold at a loss is not deductible, but personal capital assets sold at a gain is. Now, usually you don't sell a personal capital asset at a gain. Most of the time, it's sold at a loss. Like if I buy a Louis Vuitton purse or something, and I sell it. And I paid $400, that would never happen. But if I did pay $400 and I sold it for $100, it wouldn't be taxable, right?
Right. Right. I don't think you would ever buy a Louis Vuitton purse.
I wouldn't because I would buy a Louis Vuitton knockoff. That's what I'd buy because I'm basically a cheapo, But anyway, but everything else, but most people think that capital assets are the sale of stock.
Right. That's why everybody is, I didn't sell anything. I didn't sell stock. Well, what about something else?
Right. And when you think that your broker, I only moved around some money, that means your broker sold stuff. And so when you get that 1099 from your broker, don't just put it in the closet or in a drawer. You got to look at it and deal with it. But the beautiful thing is capital assets get preferential treatment. They like capital assets.
Right. Right. I mean, you could pay 0%, 15%, or 20%.
Which is the maximum. And so when you heard that, who is it? The guy from Omaha, Warren Buffett said that his secretary paid taxes at a higher rate than he did. Well, that's because most of his income comes from capital assets, which would mean that the maximum he would pay is 20%. But if he paid his secretary $300,000, she might have paid taxes at 37%. So she would have paid at a higher percentage, but he would have paid more taxes.
Right, right. I mean, and that's the thing. I mean, and that's where people, well, that's not fair. How come that's, and well, that's.
But look at it this way. If he sold $100 million of stock at a gain, and he paid 20%, he might have paid $2 million in taxes. She, at being at 38%, might have paid $100,000 in taxes. So he paid a lot more taxes at a lower rate,
right?
Because capital assets are preferential,
right? And that's where you got to know all the facts,
right?
You can't just if you don't know how the taxes work, they shouldn't be commenting on it. First of all,
Well, but
because-
then again, you listen to the news media, and they try to skew you in a certain area so that you're going to really be upset,
right,
right? That's our fake news. Anyway, I'm Esther Gullius, the tax lady. 8030930, 8030930, star 930 on a cell phone. We'd love to hear from you guys because you are what makes it so special. And why don't we go right now to Ron? Hey, Ron, how can we help you, sir?
Good afternoon, Esther.
Hey, Ron,
what-
what can we do for you?
What's that?
What can we do for you?
At what point do you have to file income taxes? Because I'm retired. All I got is Social Security, a small pension, a couple CDs, and a couple annuities. But I don't get any income at all.
Okay, well, here's the thing. Many people that don't have to file a return want to file a return because our tax code has so much social programs into it. They want to give you money. Now, in your situation, as a retiree that just has Social Security, a small pension, and maybe some interest and dividends, you probably don't have to file a return if it's under if you're single, like $12,500. However, because are you a homeowner?
I own the home, but it's a mobile park, and we rent the lot.
Okay, so if you were a homeowner, even though you don't have to file a return, you would have wanted to file the New York return to see if you qualified for the NY-229. But in your case, being somebody that is in a mobile home park and you're paying rent for your lot, you won't qualify. So if what you're telling me is correct, then you don't have to file, and there doesn't sound like there's a social program out there for you.
Oh, nice going.
Well, I'm sorry.
Well, if you want to
give
pay taxes,
right.
they'll be more than glad to take your
just
money.
give them a year. They'll figure out something to give you some money. But right now, Ron, there's no money for you.
So if it's me and my wife, it's $32,000, right?
Well, it's
It's about 28,000.
28,000, right?
28. Oh, okay, that's even worse.
All right, Ron. But I'll give you an example. If you went and got a part-time job, you might get an earned income credit. And you don't have to work a lot. You just, you might do maybe in the summer you wanted to cut grass at a golf course, right? You might get an earned income credit next year. But right now, with what you're saying, Social Security, a small pension, some small interest and dividends, you're good to go. And there's no social programs for you. No soup for you.
Okay, thank you.
Thanks, Ron. But that's really what's in the code. What's so surprising, I think, especially people that have been around the block a couple of years, they think, oh, I'm just filing a short form because I'm not itemizing anymore. Well, the truth is, so much of the tax form isn't itemizing at all anyway. It's all credits. And these credits are much stronger at refunds than when you used to itemize. I'll give you an example, especially people that have investments. There are foreign tax credits, and there's a credit for taxes paid on your investments to foreign countries. Well, the truth of the matter is, if you have a $300 foreign tax credit, you save $300. That's the same as having a $3,000 itemized deduction at 10%. And that's what people don't understand. The itemized deductions were multiplied by your tax bracket, but credits are actually money in your pocket.
Right. And Ron's question almost goes to this texter. Thank you for your show. My mother-in-law received $21,000 in Social Security and a $1,300 distribution from her 401k. She received the stimulus. Is there any other reason to file her taxes this year? And that goes to what you were saying about owning a property.
Right.
If she owns a property where she pays property taxes, she may, she could qualify for the IT-229. And now we're going to get all these calls on it.
No, but I'm happy to have.
I know.
I mean,
but
one of the things, of course, that's so like this morning. A little while ago, I just did a tax return for a widow, and she really didn't have to file a federal return. Her husband had just passed away, and they didn't owe any taxes, but she did get $350 from New York State for the IT-229.
Right. But also with the texter, if this is a 401k and not a pension, Mom could take out probably easily another $10,000 out of the 401k a year and pay no taxes.
That's right.
Put it in the bank, so if something happens to mom and you inherit it, you're not going to pay taxes on that money she already took out. So there's some tax planning you might want to do there.
That's
with
right.
mom.
What people don't understand, and I've tried to explain, and I know we got to take for a break, but what people don't understand, and I try to get them to understand, putting money in a Roth is so that you don't have to pay taxes 30 years down the line later, like you trust these people, versus taking the benefit now. I explained to them, the benefit now, probably by the time you go to take taxes out when you're in 10 or 15 or 20 years later, the standard deduction might be $30,000 or $40,000. You'd take $40,000 out tax-free anyway. So you're giving up the tax deduction now for something that you may never, ever get a benefit for later, and you're alive now.
Right.
So, okay, we got to take a break. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930. We'll see you on the other side. Linda, Greg, Cliff, and your calls.
We are family. I got all my sisters with me.
Hey, to us from EG Tax, we think of you as family, and we certainly want to help you. I'm Esther Gulias, the head mama here at EG Tax, joined in studio with Chris Fabian, and that gentleman. I wanted to make I was making the point about Warren Buffett because you remember the news media said that he was paying at a lower rate than his secretary, and I was trying to just make the point that media can twist the facts. He paid a lot more taxes than her, but because she had wages don't get special tax treatment, but capital gains do. And we were kind of talking about capital gains.
Right. And and I think the exact terminology they use is marginal tax rate.
Right.
Where you take your tax and you divide it
And
by
your
your
average.
income.
Right.
But-
So we got what else? If you sold a capital asset that was a gift, don't know what the original price was.
For example, a ring.
Right.
Well, if you don't know the cost basis,
It has a zero basis.
it has a zero basis, unfortunately.
Right. So if you don't know what it is, it's a zero basis. And that's why it's especially important for people that are gifting away assets while you're still here on this earth. You should give your heirs the information so that upon your passing, they know what you paid for it so they don't have to pay the long capital gains on it if they should inherit it.
Well, in inheritance, you get the stepped-up basis as of right now.
That's true. If you
Right,
if you
right.
did
But-
inherit.
but like-
but as a gift, if
Right,
you
but
sell
if it's a house that mom or dad gave
Right.
you before they passed, you
Absolutely.
go through everything with them.
All right,
you know.
let's go back to the phones. We're going to go to Linda. Hey, Linda, how can we help you?
Hi, Esther. Question for you. My brother passed away. He had investments of $121,000. No will, no beneficiaries. So it's kind of been a nightmare for me. I had taxes done by my husband's accountant. I haven't submitted them yet because I had questions about it. Like, what kind of deductions could I get that can bring possibly the taxes that I owe on this down?
So are you talking on the 1041 or are you talking on his personal return?
It was a 10. Wait, let me see. I think it was a 1041.
Okay, so the estate went, so that's the fiduciary return. So when you're alive, you do a 1040. When you pass away, until you distribute the assets, you do a 1041. So what all went into the estate return? Do you know?
The investments that he had.
Okay, well, if those investments were sold, they should have gotten a stepped-up basis. So what you want to do is make sure that the accountant did it correctly.
That's what I'm wondering, because he has me owing $42,000 on the federal and $7,000 on the state, and I almost fell over.
Yeah, you definitely need a second look. If you want to go to our website at egtax.com, ask the tax lady. And I'll do you can send over a copy of the return, and I'll take a look at it for you.
Okay, that would be fabulous.
Okay?
Thank you so much.
All right, thanks a lot, Linda. Hey, it's when you don't think it's right, you better have it looked at.
Yeah, that does not seem right.
It doesn't, because if the stocks, if he had passed away, there would have been a stepped-up basis on the stocks.
Yep.
And so if they were sold, they should have been sold
Right.
at,
So
at
if he
a
bought
flat.
Amazon at $25 and when he died it was worth $400 and you sold it for $425,
there would only be $25 gain per share. right?
correct.
So just want to make sure. Because many times people think, oh, this was gifted. Well, it might have been gifted to him, but as soon as he died, there's a stepped-up basis as when you inherit it. So that's important. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. And we're going to go to Cliff in Tonawanda. Hey, Cliff, how can we help you?
Hi. I bought a piece of rental property that needed a lot of work about 35 years ago. Now, when we started doing depreciation, I paid like $2,500 for a house. So at that time, they told me the land value was 10%, so $250. Well, I sold the property for $90,000. Where does the land value lay in that, or does it matter?
Well, the land value goes back to the original basis. So your basis, it's fully depreciated, right? So
Right.
so the land, if that's all that's left that you've done, you haven't done any improvements the last few years, $250 is going to be your cost basis.
Okay, so the land value would stay at $250.
Right. That didn't depreciate.
Right. It doesn't depreciate.
Right.
Okay. All right, that's what I was wondering.
All right. Good enough. You actually sold it, right?
Right.
Yeah, and don't forget to include your cost of sale. So take a look at those expensive sale papers because they go into, that'll get added to the cost basis too.
Okay, that's in the paperwork that I got from the
That
lawyer.
the attorney gave you. Yeah.
Okay, appreciate it. Thank you very
All
much.
right, thank you, Cliff. I'm Esther Gulius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. And we'll talk to Kerr from Lockport. Hi, Kerr.
Hello?
Hi, can we help you?
Yes, I'm just calling to try to figure out something. Last year, I filed taxes. I do my own. I didn't do it electronically. We did a mail-in, but it was mailed out like within the time frame in middle of April before it was due. We still have not received our refund of $813. I've gone to the website. I've tried to call the 800-829-1040 number. Still no luck. They keep saying they have no information. But they don't have, I haven't got a letter stating, like, if I was going to be audited. I haven't got a letter stating that it wasn't received. I think I would have.
Let's hang on for a second. So what lesson have you learned?
Not to do my own taxes?
Well, no, to not mail them in.
Oh.
Because number one, they don't want them mailed in. Number two, they were short-staffed, and God knows where that tax return
They are
is.
short-staffed. I'm sure that's the reason why it's
Right. Well,
delayed.
but there's more than one reason. They do not want a return mailed in, and they are looking at your return as the last possible thing for them to do. Now, I would suggest you take them in and file them electronically, and hey, you'll get your refund in a month. That's what I would do.
File my taxes.
And do not
Electronic.
do it this year paper. Don't do it.
I know, but I wasn't there. I'm not sure what I'm doing.
They haven't processed your return. You still can file it electronically for last year. Get it done electronically.
But then I'm going
Unless
to
you
have.
really don't want your money. I mean, it's up to you.
Yeah, but then I'm going to have a penalty. Because
No, you're not going to
If you have a refund coming, there's no
There's
penalty.
no penalty if you got a refund. The penalty is they're not giving you your money.
right, exactly. So if I do it just to
you
my
know,
regular.
go into one of our offices,
Electronically.
or do it online, or whatever. But you should file that return electronically.
Okay.
Because they have not processed it yet. Get it done so you get your money, and don't file paper this year.
So So if I have a refund coming from last year, they'll just add it to any refund I have coming this year?
No.
They'll process it separately. It's a separate year. They're not going to combine 21 and 20. They're going to do.
We are
would
wondering.
do an electronic 21 return and electronic 20 return. They process them independent of one another, and they will send you the refund independently of one another.
Mm-hmm. So by doing it electronically this year, they might bump it up. I mean, they might, and I still should do another.
No, you don't seem to understand. They haven't processed that return. They're not auditing you. They haven't even looked at it yet.
I know. I thought because of the delay, I know he said they hired more
No, it's not even like
to work on last year's.
Believe me, they don't want you to file a paper return.
Mm-hmm. Well, I
So
would just
maybe you don't believe me, but
the IRS
maybe next Christmas.
years ago. So
I
I
would
just
suggest you
gotta-
get it done electronically for 20.
But I
and
always
get it done for
mail.
21 electronically. Go wherever you want, but I'm just telling you, please don't do it paper.
Okay.
Okay, honey.
Just
Bye-bye.
and then would I do an amended return?
No.
Just bring it in. We'll take care of it for you. You don't have to do anything. Just bring it in.
Oh, all right.
We got an office
Right.
right there by the Big Lots Plaza.
Go
They'll-
see Sue.
Sue will take good care of you.
Oh, at Big Lots in Lockport on
Transit Road in Lockport.
That's where you are. Okay. All right. And
you,
then
will, Kurt, you will be so happy. You'll say, "Why did I not do this before?" First of all, you'll be happy because you'll have your refund.
yeah, true.
Okay.
All right. Thank you.
Bye-bye.
Thank you.
Thank you.
I mean, I know
I know people like to do their own return. I got that, but you know, time marches on. We had to let the horses go in favor of cars. So now you got to let paper returns go in favor of electronic. Hey, I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break for the news. We'll see you on the other side.
We are family. I got all my sisters with me.
Hey, everybody, this is the tax lady from EG Tax. And we would love to hear from you, what you have to say with your tax situation. 8030930, 8030930, star 930 on the cell phone. And I'm joined in the studio with Chris Fabian. Hey, Christopher.
Hello again.
Hello, Christopher. Okay, I want to talk. We're talking about capital assets, and what if somebody gifts something to you, like gifting the house, gifting a piece of land, gifting stocks? What does that mean to the sale of that asset?
Well, that person who received the gift has to know the original basis, like the texter a long time ago said about a diamond or a ring. You know, I don't know the value. If you don't know the value, you get a zero basis. But if it is
Which
the
means
house,
it's all taxable.
It's all taxable, right? So, like, if it's the house from mom or dad, you got to sit down with mom and dad. Well, you can and say, okay, what did you pay for the house? How much was that new roof? What about the furnace? What about that addition or the bathroom remodel? And get all those figures so you can come up with the basis when you eventually do sell the house.
Right, but it's a really tricky thing because many times people think if I give them the house that they're doing a good thing. But the truth of the matter is, if you give them the house and it goes back to the donor's original basis, like Chris says, plus improvements, but if they would have inherited the house, then they get the stepped-up basis, the fair market value on the date of the death of the decedent that is giving the house for the inheritance. And that's the fair market value, what it's worth at the date of their death, which means that there won't be any taxes or very little taxes due. So you want to make sure that you understand that gifting may not be the best thing to do. Life estate, especially if it's a house, might be the better solution.
Right. And the thing is with the life estate, too, make sure that's going to be the house mom and dad are going to be in till they pass away. Because if, they decide to sell the house before they pass, the children listed as the sub-owners have to pay tax on it
Right.
as a gift, not an inheritance.
Right, unless one of the kids lived in the house. Because
Right.
if the kids lived in the house for 2 out of the past 5 years, then it would go, they'd have an exclusion. Because it's so complicated, you want to make sure that you do the best, not just now, but when upon your passing and the kids want to sell the house.
Right, right. Yep. And then also, if you're doing the life estate, mainly people do that because of nursing homes. If mom or dad sell the house before they pass away and you give mom and dad that money again, you just defeated that whole purpose.
Absolutely, because then they got the assets, and that's
Yep.
going to go to the nursing home. So it's really important that you understand what to do. I'm Esther Golios, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. You can text us at 716-8030930. We had a text about, somebody wants to know about a 1095C. Like, why do we do them?
Yeah, the 1095C and the 1095B, it goes nowhere on your tax return. It's just proof you have insurance and what it costs you each month for insurance through your employer. And since it's through your employer, 99.99% of it is pre-tax dollars, meaning if you make $500 a week, it costs you $50 for health insurance. You're only getting taxed on $450. So that $50 is not deductible anywhere on the tax return because you already got the deduction.
And, people say to me, so why do they send them out? And I really think it's because back in the day when Obamacare first came out, it was mandated that the employer keep track and report to the IRS the amount of health insurance. Well, now under Trump, he eliminated that. And I just think rather than them saying, oh, forget it, we're just going to get rid of this reporting stuff, I think they thought, well, maybe we should just keep it in case they change their mind again, which they do every hour and a half.
Also, this is how our government works. They changed there is no penalties for not having health insurance, but they never got rid of that section that said that employers have to mail that out.
Right.
So, you would think they would look at the whole law and reverse everything. They only reversed part of it. So
Well,
the
that's
companies are
part
still...
of the joy, right?
Yeah.
I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone, and we're going to go to Bill. Hey, Bill, how can we help you?
Hello.
Hello, Bill.
Oh, yes. I just have a kind of a general question.
Sure.
Last few years, I've been getting a refund, and I'm just wondering, and my income's about the same every year. I'm just wondering, has anything changed a lot since last year that would change that?
So you went from a refund to a balance due?
No. I've been getting a refund every year for the past 3 or 4 years. I'm just wondering, have the tax laws changed? That's going to change my situation at my...
Well, do you have children?
No. No.
The only thing that I've seen that has changed that could affect you is your withholdings. Because there's new W-4s out there.
That's exactly right.
And if your company made you fill out a new W-4, your withholdings may have dropped. So your refund may not be as big as your...
Right. So those of you that find that your refund is a little less this year, and you change the W-4 at work, and they'll say, well, I never changed anything. That new W-4 is so confusing that many times people didn't realize that they were actually directing the employer to withhold less. So if you're confused about the W-4, you want to have help, EG Tax is happy to help you with your W-4 right after tax season. Give us a jingle, and we'll help you to initiate that corrected W-4 if you want more. But then again, Bill, did you get a refund this year or not?
Well, I didn't file yet this year.
Oh, you haven't filed yet. Okay, so you don't know if you're going to get a refund, right?
No, I'm just the only thing different that I can think of is the COVID money that we got.
Yeah, the stimulus isn't taxable.
Not at all.
Oh, it's not? Oh, okay.
No.
Okay. Well,
The only reason they even mention the stimulus on the tax return is because if you didn't get the stimulus, or maybe because your income was too high, or you just had a new child, or a child that you didn't claim last year is now on your tax return, they give you the opportunity through the reconciliation portion of the tax return to get the stimulus you didn't get.
Well, if my tax person told me to bring something with me, I forget what it was called. something to do with the stimulus.
They probably want the letter that the government's just mailed out 3 times stating how much you received, because like Esther said, if you didn't get it all, you may be entitled to it now.
Right.
So he wants proof to see how much you did receive.
All right, thank you very much.
All right, you're very welcome, Bill. I'm Esther Gillius, the tax lady from EG Tax, 8030930, 8030930, star 930 on a cell phone. Another thing people wonder about is gifting. You know, how much can you give as a gift? Does that mean that I'm going to be taxed if I give a gift? Am I going to be taxed if I get a gift? The truth of the matter is, the new gifting limit is you don't have to do a gift tax return if you gift less than $16,000 or less per person per year starting this year. So you can gift up to $16,000 without having a gift tax return. What if you gave 20? What happens then?
Oh, that's what I was just going to ask you. There's no money owed. It's just a paperwork form, and you just tell the government, instead of being worth $11.3 million when I die, I can only be worth $11,295,000 when I die before my estate would have to pay tax.
Right. So here's the thing. There's a unified exclusion, which is like $12.3 million. Okay. So until you eat up that whole $12.3 million by giving gifts over $16,000 right now, there is not going to be any gift or estate taxes due. You just are required under law to prepare that gift tax return if you give more than $16,000 per person per year. And actually, you can give more than that if you're paying medical bills directly or educational expenses directly. So let's say that you have a grandchild in college, and you want to give more than 16, and you pay for that tuition. You can take more than the 16,000 because gifts of education or medical expenses paid directly for them is also over and above the 16,000.
Right.
Right?
Yep.
Okay.
Yep.
What do we got here?
We got a big text here.
A big text.
Hi, Esther. I called the IRS after I brought taxes to you per your suggestion for a deceased person. Sorry. My TurboTax would not let me e-file, and you told me you could get it through. Originally mailed in for 2020. It was also rejected when sent in by you. IRS told me under no circumstances send a duplicate tax return. Still haven't received the refund. So what happened is there was no record of it. You came in, we e-filed it. Guess what? The IRS started processing it.
Right. So it was duplicate.
Right. And what I was just told recently by one of my clients who worked for the IRS is whenever there's a deceased spouse, it automatically gets flagged and the refund gets delayed at least a month. It has to get manually reviewed. The problem is, where's everybody working for the IRS right now?
At home.
At home. So it's taken a lot longer to review these returns manually. So you need to call the IRS. We can help you with that. You may sit on hold for an hour and a half and say, okay, you have it. What's going on with it? Yep, my spouse did die. And that person's just, all they have to do is hit a button and it will release the refund. But unfortunately, you got to wait for that person to do that with the IRS.
Yeah, so what happened is, just like that lady from Lockport that sent in her tax return, well, they must have, obviously, with the TurboTax one, processed it just when we sent it in as well. So it was just a duplication.
Yep.
Okay, let's see.
Do-
Here's another one. Do all estates have to file a 1041? An estate have to file a 1041 if there's income over $600. But if you have if a person passes away and they leave no assets, and or they leave some assets that are producing no income, no, then you don't have to do a 1041.
Right.
Okay, let's go to. I guess we're gonna take a break. I'm Esther Gillius, the tax lady. We're gonna take a short break. 8030930, 8030930, star 930 on your cell phone. Will be with you and your calls on the other side.
We are family. I got all my sisters with me.
Hey, to us, you are family. I'm Esther Gulias, the tax lady from EG Tax. You can always go to our website to ask a tax question anytime you want, any night or day. Go to Ask the Tax Lady. We're happy to help you. But in the meantime, you can give us a call, 8030930, 8030930, star 930 on a cell phone. Okay, before I go to the phone calls, we got another text here.
Yes, I told many ex-workers about the PSO deduction for retired police, law enforcement, ambulance, prison guards, etc. Up to $3,000 deduction on health care you pay out of retirement a month. They argue with me. I've always got this credit since I retired in 2008.
Well, it's not really a credit.
No,
It's a deduction. Okay, so that what you do is you reduce your taxable pension by that $3,000 if your health insurance is really being paid out of your pension. So if you got a $30,000 pension, you on your 1099-R, you would put $30,000 on the one part of the tax return, but you're only taxed on 27, and you have to take that $3,000 off.
Right. Yeah, so for any public safety officer who, that you do, if as long as, like Esther said, the insurance comes right out of your pension, you do get that deduction.
But and the thing is, you can tell them, tell your buddies, your ex-workers that you were working with, if they want to overpay, they can overpay. People can overpay doing their taxes, and they do all the time.
Yep.
But if they want to get a credit, a deduction, all they have to do is amend their last 3 years' returns, and they'll get the refund back for the $3,000 that they've overtaxed themselves on.
Right, and that could also impact the amount of taxable Social Security, too. So they could be...
And a lot of, like this morning, I just did a tax return for a person that got the... firefighters' pension. When you're a volunteer firefighter, that's tax-free on the state of New York. They're happy to tax you on it if you don't want to take it off.
Right.
But if you reduce that by, if you're a firefighter, if you reduce your New York State by the firefighters' credit pension you're getting, you'll get the benefit. If you don't want to, hey, overpay, right? Yeah. Okay, let's go back to the phones. We're going to talk to Rob. Hey, Rob, how can we help you?
Yes, hi. Thanks for taking my call. How are you today?
Yeah.
So
Good.
I filed my income tax back in February. I received my federal tax return, and I did an e-file. I'm still waiting on my New York State taxes. And when I look online and I do the follow-up, it says, we received your return, and it requires further review.
Oh, well, that's a New York State ploy, though. They do that a lot.
All right, because I had called, asked, I was like, I don't know, because my wife owns her own business. That's all included with it. We pay somebody to do our taxes, and I was like, I don't know if I'm being audited, if I missed a letter that came through.
No, I have to tell you, as time marches on, the state of New York does this a lot. Don't you? Would you agree, Chris?
Oh, yes. Did you say you e-filed or sent it in paper?
E-file.
Okay. So what it could be, and this is something New York State is infamous about, is you're going to get a letter requesting W-2s.
For you to send it into
to
them.
prove your withholdings, because they're going to say, oh, we never got the W-2s from your employer, so you have to prove your withholdings. And all it is a way for them to delay giving your refund for about 6 months. So I would try to call New York State and saying, I checked the status. It says it needs review. What can I get for you?
Right, you can fax it in.
Be proactive
Yeah.
to speed it up.
I did that the other day, and they gave me the same exact response that's on their website. And that was a live person that I talked to.
All I can say is some people end up with this review from New York State. The truth of the matter is you'll get your refund. They're just going to hold it up.
And if you want to give us a call, I hate to say this after April 18th, we can call New York State with you, and we have a tax practitioner line that they give special treatment to, and maybe we can get a better answer than the generic one you received.
Right.
Awesome. Thank you.
All right, Rob. Thank you. And we will help people that are our clients or aren't our clients, because we just believe in helping people as best we can. Like I said, we're family. We have another question. Can you open a health savings account if you have health insurance through the New York State of Health? If so, where?
Well, that depends on what type of health insurance you have. You have to have a high deductible, and I believe it's $1,800 for a single and $3,600 for married joint. If your deductible is that high, then yes, you can do an HSA. I would go to my bank. I know KeyBank does it. Northwest has them, but go to your bank and see if they have an HSA, and then you can go ahead and do it right there.
Right, and obviously, I'm assuming that you have a tax liability, because then it becomes a lot like an IRA, because it's a deduction that you create. Speaking of IRAs, if you're somebody that if you're working and maybe you don't have a pension plan, or you have lower income, or you have a spouse that isn't covered, and you find out that you have a balance due, using an IRA this time of year is a great tool to reduce your taxable income, number one, and number two, maybe qualify for the pension savers credit.
And not to mention, I mean, if you have it sitting in the bank, what are you getting on $7,000 right now?
Absolutely.
2 cents, maybe. Where if you put it in an IRA, on your tax return, it could turn around to be maybe a $1,500 to a $2,000 subtraction or benefit for you on your tax return. So that's much better than 7 cents
Right.
a month.
I'll say to my clients, how would you like to make 30% on your money today? And they go, are you selling something, Esther? No, I'm not selling anything except knowledge. You can create your own individual retirement account if you're an employee or or are self-employed, and you fit these parameters. You have till April the 18th to put this money in, and you can get 40% on your money by taking advantage of this.
Right. And people will tell me, well, I don't want to put it in the market. That's just, you don't have to put it in the market. You can put it
in the bank.
In the bank, in an IRA, still getting that 2 cents a month, but you just saved all that money on your tax return.
That's right.
I mean,
All right, let's go quickly to Joe so we can fit him in. Hey, Joe, how can we help you?
Yeah, have a situation here. I have a father-in-law whose health isn't in the best of condition, a mother-in-law that's currently in a nursing home, and both of their names are on the house with a life estate to their grandson. And my father-in-law is in the understanding that if he passes, my grandson or his grandson could therefore sell the house and then use that money to buy a house of his own. And, that's the gift that he was, leaving for his grandson. I'm not sure with my mother-in-law still being in a nursing home, how that, what goes into play there, and who gets, what the proceeds are from the sale of the house. But all goes.
Was both their names on the house?
Both of their names are on the house, and the life estate is in the name of their grandson.
Yeah, unfortunately, the grandson's going to have to wait till both grandparents pass away.
Right.
Otherwise, he could have a huge tax burden on his hand.
Okay, so that needs to be addressed, and because the situation with the house now, he would not be able to maintain the house or to get, keep that served. Okay, well, that's a great help. I will address that, and hopefully, iron out some things so things aren't as difficult as.
Right, but just be careful that you don't feel tempted because the grandson says, "I really want to sell it because I really want to buy a house." Because you want to take a look at what the tax consequences are. Now, it may be that they bought it relatively short time ago, and there's a high cost basis. And after you do the pencil and paper thing, you're going to find out that maybe you don't want to wait for the second to die, but. You got to make sure you do the math to make sure it all works out.
Okay, excellent. Thank you very much.
All right, thanks, Joe.
Yep.
Hey, I'm Esther Gulias, the tax lady from EG Tax. We do have 28 days left until the end of tax season, and our offices are here to help you. We have an office that is open on Sunday at the McKinley Mall if you are so inclined. Just a suggestion, time is going to get might get away from you. You certainly don't want to wait till the 14th, 15th, 16th, 17th, 18th to do your return. You're going to feel pressed under the gun. The taxes are due on the 18th. I just had a couple in today that said, well, gee, we owe $4,000. When is it due? It's due on the 18th. Well, what do you mean it's due on the 18th? It's due on the 18th. What they do from that point in time, so then they said, well, let's do an extension. The extension doesn't extend the time to pay the taxes. It only extends the time to mail in the actually send in the tax form. So you still owe those taxes on the 18th. Now, they will set up a payment program, and there are options for you if you do owe money, but you would want to know those options now so you can plan ahead. Waiting till the 18th of April is not the best time.
Right.
Would you agree,
right.
Chris?
Oh, totally. I'm blown away by how many people. I know I'm going to owe. I just don't know how much money I'm going to owe. So that's why I waited to now. Well, I would rather known in February so I could plan to pay them the $10,000
And those of you that are self-employed, especially I can think of realtors that had a phenomenal year, you can do a simplified employee pension, SEP, and if you don't have the money now, you get your paperwork prepared with the SEP, you pay your taxes now and file an extension. That extends the deadline to open up the SEP, and that will save you a lot of money too. So there's several things that we can do this late in the game to help people that are self-employed as well.
Right. And then, another thing, people, you talk about people owing money. What I'm seeing this year is people who are, I don't want to say heavily invested in the market.
Oh, they made
but
a ton.
They made a fortune.
A ton.
And they come in and their mutual funds, their capital gains are huge. I had somebody yesterday had $100,000 in capital gains, and this poor little old lady, I shouldn't use the word poor, but almost had a heart attack in my office. We had to call our broker right away from my office to say, you need to transfer funds to her checking account so she can pay.
Absolutely. So, and make sure you take a look at that. 199A is a deduction for your QBI, and don't overlook the foreign taxes paid, right?
Right.
Hey, until next week, I'm Esther Gullius, the tax lady from EG Tax. Our website is egtax.com. I hope you have a great week. God bless you guys. Thanks for listening.